Hi, I'm Seth Freudberg. I'm the Director of Options Trading here at SMBU in Manhattan. I'm also the head trader of SMB's options trading desk. So it's been a volatile and interesting beginning of 2016. We have experienced very large sell-offs in the market, followed by very large rallies, big intraday swings, and so forth. This is the kind of thing that's great for SMB's day traders because movement is how they make money. For those of us who trade positive theta market neutral options trades, this is a little bit more of a challenge. So we took a look at the mix of trades that we're doing on our trading desk. And to make it simple, basically 85% of our desk is trading some form or another of the M3 strategy. And the remaining trades you could more or less bucket into something like a bearish butterfly. And what we did was we studied the way those two trades perform over time in different kind of market environments and found that, in fact, in this kind of a market environment, the bearish butterfly is going to perform a bit better. And so what we decided to do was to tweak our book of trades so that and it was a tweak, but because we're trading almost $6 million in capital, a tweak is a significant dollar amount on its own. And so what we did was we studied different proportions of the M3 strategy versus the bearish butterfly to try to see if we shifted the weighting of one versus the other, how would our trading portfolio perform? And it turned out a very interesting result, which caused us to take a very interesting action, and that is if you shift your portfolio of trades from 85% M3 and 15% of these sort of bearish kinds of butterfly trades and move it over to 75% and 25%, so that you do 75% of your portfolio in the M3 and 25% in the bearish butterfly, you have three interesting outcomes over time. One, if the back tests are reflective of reality. Number one, your win rate is actually going to go down. Now that sounds like a bad thing. Why would you want your win rate to go down? And the answer is because everything else that happens is good. The expectancy on the trades is more than double, so that your returns for your entire a portfolio of trades should improve substantially over time once you implement this change. And thirdly, the maximum loss in any 1 month tends to go down. Now that one is less counterintuitive, put it that way. That one I would say would be intuitive. When are the big months where most people struggle in market neutral options trading? Usually, typically, not always, but typically, it is when there is a very large, dramatic down move or a crash of some sort. There are other scenarios where there are struggles, and it's very simplistic to say that's the only case where you're going to struggle. It is not, but it is probably the times that have been most problematic for most market neutral options traders. And so it shouldn't be too counterintuitive that a strategy such as the bearish butterfly, which performs pretty well in a down market, would cut down the size of losses in your otherwise losing months. So the other thing that's interesting is that the bearish butterfly is just a strategy that has a generally better expectancy than the M3. So the fact that the expectancy went up makes sense. The fact that the maximum loss over a period of time of a portfolio made 75% of M3 and 25% of the bearish butterfly, the fact that that expectancy would improve also makes sense because the bearish butterfly strategy itself has a bit of a better expectancy. I would say the one counterintuitive thing was the win rate going down, but you're willing to sacrifice that if your return's going to improve and your drawdowns will be less. Now, can I predict the future? No, I cannot. Is it absolutely certain that what happened in the past will happen in the future? In fact, it's guaranteed that it will not be the same. But whether the tendencies will be in the direction I'm talking about, that's what we'll see. We're hoping that's the case. And by the way, this kind of a tweak may change again. If the market changes more back into an environment that's similar to a 2013 or 2014, we may tweak the shifting again. Again, you have to be intelligent about it. You have to use your common sense. If the market dramatically changes, you take a look at your mix. So I offer that to you as a way to think about handling your own portfolio of trades with your own capital, whether you're trading for a prop desk or not. Take a look at your mix of trades and ask yourself the question, is this the same environment that I was in last year? I think the answer is clearly no. Should I make a tweak to my portfolio of trades to deal with this change? That's a little bit more of a subtle question. We decided to answer it through this shift we're making. We're not saying we're right. We're saying it seems logical. It seems like a very smart thing to do right now, but time will tell whether we were right or not. For all we know, may have been better to just leave it alone. But our instinct is this is a different market environment. In this kind of environment, it's better to have something which performs well in big sell-offs as a larger proportion of what we're trading. So I hope that this helps you to at least think about your portfolio trades. At a minimum, you should go back test your strategies and ask yourself, have I traded this strategy through this kind of a volatile environment? If I have and it held up beautifully, maybe you don't want to change anything. But if it did not hold up beautifully, maybe you want to consider tweaking your portfolio a little bit to handle a more volatile market environment like we're in. So I offer you that. I hope that it's helpful. Please at least think about it, and hopefully it will help you to improve your game as an options trader. That's what we're about at the Options Tribe. Thanks very much, and we'll see you next week.
Check out SMB Trader 90, where you have access to all of our trading tools. We're sharing trading ideas before the market open and throughout the trading day.